Hey everyone, I'm Victor Fong. I'm a financial consultant by profession. In my last video, I shared with you about the different kinds of financial instruments that you can invest in. Some of them generally give you more stable returns, while there are others that are more market dependent. Their value of the investment rise and fall according to market conditions. Now today, I'm going to talk a bit deeper about more on market dependent kind of investments and what you can do if you plan to invest in them. Right, so just to recap, whenever you plan your investment, you like to plan it as if you are building a tree. Generally, investments that are more stable returns are like your roots, they generate an income for you, while the tree that grows above the ground are like your assets, they are dependent on the rise and fall of the market value. Right? In a financial crisis like this, where the coronavirus is happening around the world, your assets might be affected, they might fall in value. But as long as you have roots that are strong, that give you a stable form of return, in time to come, when the market picks up, your value of your assets will rise back as well. Right? And in the last video, I talked about the different kinds of investment that you can invest in that are more stable in return. These are represented by your cash, your CPF, and your endowments. Today, let's go a bit deeper. Let's think about what other instruments that you can invest in. Perhaps bonds, stocks, or properties. Now you find that properties generally are a bit more capital intensive. Alright? Bonds and stocks, generally you can invest in them if you have a certain sum of money to start off with. Right? So I suggest maybe start off with about 1,000, but don't take my word for it. Check with your financial consultant and probably they'll give you a more customized advice on how you can do investment such as this. Okay, now for investment, generally people like to do like one-time investment. Okay, you invest one time, you hope and wait for the market value to rise, correct, and then you sell, and that will represent your profit. Okay, just generally when people approach investment, this is what they plan to do: buy, sell, profit. Okay, now I would suggest if you are new to investing, a better way for you to do is to do this concept called dollar cost averaging. Dollar cost averaging is a concept whereby you're not putting lump sum money into your investment. You are putting your investment at regular intervals, like maybe once a month, once every quarter, once every half year, or once a year. Okay, so the market goes up and down in this manner. Okay, what dollar cost averaging does is, at a certain point in time, say maybe it's January, you will input a sum of money into this investment. Alright, so you will buy a certain amount of shares or unit trust, we call it units. Right, say maybe in February, okay, you put in another sum of money. Okay, maybe March, you put in another sum of money, and so on and so forth. Now you realize there are certain point in times where the market value is high, okay, and you're entering at this price. Then there are certain times where the market falls and your investment is buying in at this price. So another month, maybe the investment is buying in at another price. So what you can do with this strategy is you are not affected by whether it's the up and down of the market. You are just more concerned about putting in the money regularly. Okay, with that you can sort of tide through the volatility of the market, the ups and downs of the market. You just enter at a fixed time, and in average out over the long run your investment value. Okay, so this is one of the simple way to approach investment rather than just putting a lump sum of money at this point in time. Say maybe for example, if you are just doing a one-time investment, say if you invest at this time, your value will go up. But what if you're investing at this point in time and then months later your investment falls to this value? You're basically taking the full drop in the value of the market, right? And that's why it's important for you, if you are considering to start investing, right, treat dollar cost averaging as your first key strategy to invest. With that, I end my video for this session. I hope to share more concepts with you in my later videos. Cheers.